Hello guys, welcome back to the Lumley trading video. In this one we are going to be going through the pattern day trader rule, also known as PDT. Now you may not already know what this is, or you may have just heard something small about it. You kind of wanted to know more about it before you dive in the deep end of trading. So it's basically just a regulation, and this is done by the SEC. But basically all it means is if you're using a margin account, again we'll kind of go through this more at the end, what a margin and cash account and the difference between them if you don't already know. But if you have a trading margin account with less than $25,000, then it means that you are not able to take more than 4 day trades in a 5-day business day rolling period. So again, if you are a day trader, this is really going to limit you if you are using a margin account, because again, then you can't take that many trades. You can only take 3 trades basically a week. So in that case, it's not going to be ideal. And just what is a day trade? I mean, it is quite simple, but it's just when you buy and sell on that security on the same day. And again, if you're a short trader, that might mean you short it and you buy it back in the same day. That both counts as a day trade. So what are the advantages and disadvantages to this? Really, the only advantage I can really see linked with PDT is it kind of just keeps, well, less experienced traders kind of blowing their accounts quite quickly. But again, this doesn't always work, and I'll kind of go through that in a sec. But yeah, the reason it kind of helps inexperienced traders is, again, you're less likely to blow your account if you can only take 3 trades a week. So that's one advantage to it. But again, it can also make people actually risk more money, because you may see you've only got 3 day trades. You want to take this good opportunity. So then you kind of take it, and then you're maybe forced to swing it. And then again, you can maybe turn a profit trade into a loss trade. But again, that's just part of that rule. Now, the main disadvantages is obviously it is going to be quite restrictive. If you are trying to trade on margin and you have less than $25,000, which I mean, the majority of people getting into trading, most likely are trading with, you are, kind of limited. You're not able to kind of trade. Maybe if you've been paper trading and you're consistently profitable paper trading, as soon as you go into real money, you may not be able to do that same strategy, or just really limited on how you can do that strategy, because again, you can only take those 3 trades a week. And then again, it can kind of lead to unintended consequences. And again, we'll kind of go on to this, I think, on the next slide. But it's really just people try and avoid it. I mean, like any rule, people try and get around. And there's multiple ways you can do this. For example, you can open up multiple different brokers. So maybe you trade with, say, $5,000. You could open up 2 brokerage accounts, one with 2,500, the other one with 2,500. And then you can essentially take 6 trades a week. So that is kind of one workaround, but again, it means you kind of got to spread out your money. So again, then you might not be able to take the trades you want. And again, then it kind of may make you a bit less risk managed. Again, if you are maybe on the newer side, the advantage of it is, again, it keeps you kind of limited. So you're only taking those quality setups. Whereas if you're going work around of maybe using multiple different accounts, then again, maybe you don't pick the great trades. You kind of just pick anything that shows itself. So going on to kind of the final slide, and I imagine what a lot of people are looking for is, can you avoid it? So one thing actually I do want to note, because I don't think we went through it in the other slides, is firstly, if you're not a US citizen, it doesn't really apply to you. So, you know, like me, I am a UK and US citizen. So before I got my US citizen, I could trade from UK brokers without the PDT, because again, if they are UK based regulators, then you don't have to follow it. But a lot, especially if you're trading options, I've noticed, because the problem in non-US brokers is a lot of them are leverage products. So like in England, and I think most of Europe, we use CFDs. They are illegal in the US because of how leveraged they were. So a lot of brokers in England will mainly trade to CFDs, and that's why, even though I got UK citizenship, I trade through US brokers, because to trade options from a UK side, it's just really difficult. And I think you have the same problem most around the world. So if you're an options trader, you can't really avoid this PDT. Mainly all the brokers are going to have PDT. Even things like Tastyworks you can get from a country in Europe, but it's still a US regulated broker, so it is still going to follow that PDT rule. But yeah, so that's kind of the main thing. Again, if you're outside of the country and you're not a US citizen, you can maybe just go and get a broker in your own country. But again, you kind of need to see, are they CFDs? Because again, that's not going to be a great thing. And are they a reliable broker? Because most of the big name brokers are from the US. So again, that's one potential workaround. And maybe if you're trading actual stocks, CFDs may not be worst case scenario. And so again, it's just always going to depend on your own situation. But if you're trading options, you're probably going to have the PDT. If you're trading stocks and you're not a US citizen, you can probably avoid that PDT just by going a country in by using a broker from your own country. But now, how can you properly avoid it if you're a US citizen, like I imagine the majority of people watching this video are? So firstly, and probably not an ideal answer, is if you're a stock or options trader, you can move to the futures or forex market, because this doesn't have the PDT rule. And this is really kind of one of the problems I have with PDT, because the reason they said they created it was to kind of stop kind of massive losses, people who can afford it, unintended losses. But they allow you to do it in the futures and forex markets, which if you are less experienced, you are going to lose a lot more money in those markets because they are a lot more leveraged. You can go in with the futures. At S&P future is $12.50 a tick. If you're holding that in the options or the stocks, you know, it's going to move nowhere near that amount. So to me, that doesn't make all that much sense from a regulation standpoint. But that's just how it is. That is one potential workaround. Maybe if you just trade, for example, the SPY, you trade that maybe using stocks, using the ETF or options. If your strategy just maybe is more technical or news-based, you may be able to trade that on the futures. Obviously, if you're using maybe option strategies and complex options, then obviously futures may not be a workaround. And obviously, if you're trading or you like trading FX, and obviously the futures or the Forex can be there for that. So that's one workaround. Then the next one is a cash account. We did talk about this at the beginning of the video, but it's a difference between a cash and margin account. So a margin account, like we said, is where you use the broker's money, or you just potentially borrow the broker's money. So what this may mean is, again, if you are day trading, let's say you have $2,000 in your account and you are day trading stocks. So stocks take 2 days to settle. So let's say you day trade, you buy $2,000 worth of stock on that Monday, you sell it on that Monday. If you are trading on a cash account, you don't have access to that money until the Wednesday. But if you're on a margin account, you can use that money instantly. The broker will essentially let you borrow it. So that's going to be the main difference. So if you require a large amount of your account to take your trades, then you're going to have to go with a margin. But then again, you're going to be limited by that PDT. Now, if maybe, for example, you take in maybe small caps and you go maybe say $500 a trade, but you know you're maybe risking 10%, you're allowing it maybe to swing 10% to the downside, then obviously you may actually be quite all right by trading in a cash account, because then you can still take 4 trades a day if you're only taking $500 of capital into each trade. So again, it's always going to depend on your strategy, how you trade, if you can kind of use a cash account, especially if you're a short bias trader. You can't use a cash account. You need margin to trade short bias. Or by short bias, I mean shorting shares. I don't mean by buying puts. So you can't use a cash account if you're a shorter. So again, that is one potential workaround, just depending on your own strategy. But again, if you're on the large cap side, that's probably not something you're able to do, because usually you have to go in with, because they're not as volatile, you tend to go in with a larger amount of capital. Now, one workaround is kind of just trade fewer times per week. So again, especially if you're on the newer end, like we talked about in the advantages, it can actually be a good thing, the PDT. Especially when I was getting into trading, obviously you start off, you're paper trading, you get somewhat successful in paper trading, you want to move to real money. Most times when you move from paper trading to real money, you'll still lose money. The reason for that is, again, when you're paper trading, you don't have the emotions, and really it is just trading. You don't have the spreads. Usually aren't as wide when you're paper trading. So there's just a lot of different factors when you move from paper trading to real money that most of the time you will still lose money, or you will tend to lose money when you first go to live money. And again, you kind of got to lose money to start making money. So that's why I quite like that PDT in that sense, is when you take that transition, you're limited to those 3 trades. So you're going to take quality setups, and then again, if you take those losses, 3 losses a week shouldn't have too much of an impact. And so it can kind of get you used to trading your own money without actually maybe having significant capital losses. So that's one key thing. And then going on to the last 2, so increase account balance. So if you maybe got a lot of money sitting in the bank, I mean, most people don't really have $25,000 to spare. But if you do, again, that's one possibility. Again, you don't have to trade with all of that $25,000. Maybe you only want to trade with $1,000 or $2,000. but you can just leave that in the account and trade with it. But again, that's not going to apply to most people. Most people don't have $25,000 lying around. Now, on to the last way to avoid this, and that's by using an offshore broker. Not something we would ever really recommend, and the reason for that is, again, they're not regulated by just a big country in general. Usually they're going to be like something like the Bahamas based. So again, their regulations are nowhere near as strict as the US. And again, sometimes if they go bust or something, you aren't entitled to get your money back like you are if they're in the US. So that's always going to be your risk. But again, if you're trading with an offshore broker, maybe you're not trading with that much. Maybe it's $1,000, $2,000. And maybe you can kind of afford that risk. You say if the broker goes bust, you lose your money. You lose your money. I mean, can you deal with it? So that might be one alternative. But again, you're taking on that risk of it not being registered. But also there is one kind of massive disadvantage, is they tend to have really high commissions and really high monthly fees. So one of the big ones, at least currently, is CMEG. And I know if you want to trade with them, I think it's about $200 a month just to use their platform, because you have to use DAS Trader. And if you want to trade options, I think the minimum monthly fee is $350 because you have to use a different platform to do that. So instantly right there, you're spending about $200 to $350 a month. And again, the reason you're going to this offshore broker is you don't have $25,000 in your account. So that's the kind of problem, is you've got the high monthly fees, but you've got a small account. So to even offset that, if you'd have got a $2,000 account, you really got to make 10% a month just to, at a minimum, cover your monthly fees. And then again, that doesn't even account for the commissions, which on a lot of these brokers, I think CMEG, it's still something like $5 aside. So you're taking $10, let's say it is that $10 of commission just to enter and exit a trade. And then you've also got that $250, around $250 monthly fee. So again, it's really going to be hard to make money using these offshore brokers, because again, if you're using that offshore broker, you've got a smaller account and you're probably newer to trading as well. Because, you know, if you've been trading, you've been successfully trading, at that point, you probably do have that more than that $25,000. So you shouldn't probably be impacted by that PDT. So really, that's why I don't think offshore brokers are going to be that great of a choice, because the reason you're using them is to avoid, you know, the having more money in the account. And if you can't afford more money in your account, you probably can't be affording to pay for these monthly fees and commissions and still expecting to make a profit. Because, you know, let's say if it was on that $2,000 account, to make 10% a month, let alone, or kind of alone, is impressive. But to do that and still expect to make profit over that is going to be difficult. And again, that's why we kind of don't ever recommend using those offshore brokers. We'd even recommend it if you can go to a cash account. But if you can't, if maybe your strategy, again, you've got to use a lot of capital to take these trades, just keep a normal PDT account and just take those 3 trades, increase your success, only take those high quality setups. And then again, if you can see, you know, 3 months down the line, you're consistently profitable, maybe then if you got the money, throw in some more money. And again, you can just kind of scale it up. The quicker you scale up, the more you're profitable, the quicker you're going to be able to hit that $25,000 PDT compliance. So that is kind of just a breakdown on the PDT. If you enjoyed the video, why not drop a like and subscribe if that helped you? Definitely let me know in the comments if you thought I left anything out or there's still something that is a bit unclear. Otherwise, I hope you see you in the next one, and that's it. Peace.